Hi, I'm Linda Eedes, and I'm going to be talking to you today about the RECM Global Fund. We manage this fund in exactly the same way as we manage all the other funds at RECM, and that's using the value investment philosophy. What that seeks to do is to grow in real terms whilst protecting against permanent capital losses. Now, the second point is very important because if you look at the fund's returns over the last year, it doesn't look like we've met that objective. The fund's returns have actually been negative. So we need to think about whether those losses are permanent or temporary. Now remember, as a value investor, you need to invest in businesses that are trading substantially below what they're worth. That is basically how you stack the odds on your side of investment success. If you buy at a very low price, then the downside from that point is limited, but your upside is immense. To protect against permanent capital losses, you have to not invest in or steer away from those assets which are priced substantially above what they're intrinsically worth. And often that's quite difficult to do because firstly, that can persist for quite some time. The momentum can be quite strong. The problem with momentum is you just don't know how long it's going to last. And often those are great businesses which are priced very attractively because they are great businesses. But the market gets ahead of itself, and even then, the businesses cannot meet the expectations that are priced into those share prices, and you have a negative investment outcome. So people often get confused between a good investment and a good business. In the fund, we've increasingly moved our exposure towards those areas of the market which are the value opportunities. And those have been in areas such as mining, and there specifically I'm talking about platinum, less so about areas like iron ore, which we don't have exposure to, because there are different underlying fundamentals for the individual commodities as well. It's not just blanket exposure. To oil and gas producers, particularly the lowest cost producers, which are best able to endure an environment of low energy prices, and other areas which have come under pressure, such as UK and European retailers. So I think it's also important to note that the portfolio is not just a portfolio of mining stocks. It actually has many other investment ideas outside of that space. But interestingly, if we think about mining, because obviously with mining having gone through quite a difficult time over the last few years, the perception is that that is a very risky area of the market to invest in. For us, risk is about the price you pay. If you buy very expensive assets, then they are risky by definition. If you buy businesses which are inexpensive at the price you've paid, then they are not risky. And that, when I'm talking about risky, I'm talking about the risk of permanent capital loss that you get from buying in things which then have a decline to what is more realistic. In the last market environment, where mining stocks were cheap in the context of an overall environment that was expensive, you're talking about the 99, 2000 sort of market environment. So just prior to the dot-com bubble bursting. Now, if you cast your minds back to that environment, it was quite similar in some respects, in the sense that it was about new technology, it was about the new world, and less about the old world. And some of those themes are certainly creeping up today, with companies like Tencent being in favor, Apple being in favor, and less so, obviously, the more tangible businesses such as mining producers. In that market environment, when mining was cheap, the market fell by 49% from peak to trough. When the market realized that the prices that were being paid for these wonderful businesses was just simply too high, mining actually went up in that market environment by 21%. Not because the mining companies were doing well, but because they were priced too cheaply at the starting point. And over the last month, we've seen businesses like Anglo American Platinum, which is a big stock in the fund, up more than 20% in the context of a global environment which is down almost 7%. Not because those businesses are all of a sudden facing good times, but because if you buy businesses that are priced cheaply, you're stacking the odds in your favor of investment success from that point onwards. This fund is trading at a discount of about 30% to the overall fair value, and that includes, by the way, 20% in cash, which is a wonderful buffer in the case of a significant market decline, and provides with dry powder to invest in businesses which become cheap. And that discount to fair value represents upside of more than 40%. If you think about something that's priced at 70, which is worth 100, that movement from 70 to 100 represents more than 40% upside. If even half of that comes to pass, that is very attractive in the context of a market environment which is priced at the expensive level and which, as a result, has significant downside risk attached to it. Thank you very much for your time today.